Hello everyone, I'm Shruti and welcome back to our weekly tanker market podcast where we discuss the latest trends and insights in the tanker market. With me today are Trisha and Sandesh to update us about the crude, CPP and LNG markets. Hi Trisha and Sandesh.
Hi Shruti, happy to be here. We have got an exciting mix of updates to cover today, so let's get started.
Alright then, Sandesh, let's talk about the crude tanker market. It seems like the VLCC segment had a mixed week. What's the situation there?
Certainly, Shruti, the VLCC segment showed minor signs of recovery. It was in the at the start of the last week, but it remained largely flat. And market participants are optimistic about pickup after Bahari week. However, the typically robust winter demand has been surprisingly weak this year, leading to a quieter than expected season. So, toward the end of the week, we saw some improvement driven by a drop in oil prices and private negotiation in the Middle East. That means those negotiations take place during the Bahari week. Now, there is also anticipation of new cargo announcement, which has been given owners a glimmer of hope. And that said, rates are still lagging behind their usual seasonal benchmarks.
That sounds like a challenging environment. Did other regions like West Africa see similar trends?
Well, Shruti, in West Africa, or we call it as XWAF, the market managed a slight improvement. Rates held steady, supported by vessel owners pushing back against lower offers. However, with an oversupply of ships, any gains have been capped. On the production front, Libya has returned to full output, boosted OPEC's production in October by nearly 5%. This increase was led by Libya, Nigeria, and Congo. And as you can see, Libya and Nigeria, their production always happened at the time when there is some volatility in the market. And although we saw production cuts in the regions like Iran and Iraq, market seems to be stable now.
Interesting. So, what about activity in the US Gulf?
Well, the ex US Gulf market struggled last week and it remained weak across the board. Factors like hurricane related export disruption, muted Chinese demand, and poor refinery margins have kept activity subdued. Adding to that, mild weather in Europe and US has lowered heating oil demand, and that further reducing shipments. And overall, this has left rates under significant pressure.
Alright, so from what I understand, despite the challenges, we saw some movement in freight indexes. So, what stood out to you?
That's right, Shruti. On key VLCC routes, world scale levels climbed for TD2 and TD3C, and they rose by nearly 14% to close at world scale 57.3 and world scale 56.1 respectively. Similarly, the another benchmark route, that is TD5, TD15, sorry, uh, it saw an increase of 8.5%. While TD20 it dipped slightly by about 2%, and these numbers reflect some resilience in the tanker market, specifically for VLCC. The market remains far from the robust.
Alright, so moving on to Suezmax and Aframax tankers. Did we see any notable shifts there?
The Suezmax segment was relatively subdued if you compare the same with VLCC, but it particularly remains subdued on ex-MEG routes, that is Middle East Gulf, and activity was limited, but rates edged up slightly towards the week's close, and that was driven by reduced availability of tonnage as some vessels were privately booked, that is during the Bahari week. And on the XWAF routes, sentiments weakened gradually with fewer cargoes available. And even so, Shruti, owners have managed to keep rates from falling sharply. For Aframaxes, the market saw consistent declines, particularly on ex-MEG routes. Demand remained low, and without new cargoes, excess tonnage is persistent issue. Similarly, in Southeast Asia, that is the region of Brunei and Malaysia, where India also get crude oil shipments from. In that particular region, charterers preferred private negotiation for November cargoes, keeping spot demand almost muted. Aframax rates dipped by about 6% week on week, and that reflects a continued oversupply.
Thanks, Sandesh. It seems the crude tanker market across segments is facing persistent headwinds with only some optimism.
That's right, Shruti. While there are some positive signals, the market is now waiting for stronger demand. That's supposed to be coming from China because there is another stimulus package on the horizon. And at the same time, we also have to look about the better balance between supply of tonnage and availability of cargo from across all the regions, specifically from the Middle East. So that's it from my side. Thanks, Shruti.
All right, thanks, Sandesh, for that update on the crude market. Now, let's dive into the CPP market. Trisha, I would like to ask you, how are the LR and MR tankers faring?
Right, so the LR segment, it had a mixed week. And for the LR1 rates, if we were to see for the Arabian Gulf to Japan route, which is the TC5 route, it edged up slightly to world scale 105. So that gave a modest boost to the earnings. And as for the LR2 rates, they were quite steady around world scale 95, but remained in demand due to tighter supply, especially for longer haul routes. Now, for the MR segment, it struggled a bit. So, the rates from Sikka to Japan, it saw a slight drop, and the East Africa route declined more sharply, and it fell around world scale 166. Now, while earnings for these routes are still above operating cost, oversupply and limited cargo volumes are keeping the segment under pressure.
Oh, but I heard there were some encouraging signs in the east of Suez market. Could you elaborate on that?
That's correct. So, towards the end of the week, LR1 saw increased inquiries driven by naphtha demand for late November and early December. And the LR2s also benefited from this. So, with rates climbing a few points higher than LR1s on the same routes, the seasonal demand is lending some support.
All right, and what's happening in regions like North Asia and the Mediterranean?
So in North Asia, MR rates firmed up slightly due to tight vessel availability. Now with routes like the UK continent to US Atlantic coast, it was holding around world scale 86. While in the Mediterranean, LR rates are steady. So Mediterranean to Japan LR1 rates, for instance, are around $2 million lump sum. Now, but overall fixing activity remains muted. Without fresh cargoes, these rates are unlikely to move much. Now, if you were to compare the same with last year, we saw pre Thanksgiving peaks with some routes earning up to $40,000 per day. While this year the rates are lower by about 25%, and the global TC index it reflects this dip. MRs are under a particular strain with around 10% of the fleet operating at unprofitable levels.
Okay, thanks, Trisha. It sounds like the CPP market is a mix of challenges and some pockets of recovery.
Exactly, Shruti. Now, while the broader market is struggling with oversupply and weak demand, seasonal factors and like tighter supply in specific areas are offering some hope.
All right, so let's move on to the LPG market now. We have Akhilesh with us to update us about the LPG market. Welcome, Akhilesh, or should I say, welcome back, Akhilesh. Please update us about what happened in the LPG market last week.
So thanks a lot, Shruti, for having me again. So it's like in the east of Suez, oversupply of vessels have been keeping the rates low, especially on the routes like the MEG Japan, that is a BLPG1 route. But in the west of Suez, steady cargo flows, particularly from the US Gulf, has supported rates. Seasonal demands from Asia for December and January laycans is also contributing to firming in the west.
Oh, so would you say that the west of Suez market is poised for further gains in the near terms?
Yes, potentially yes. It all depends basically upon the US exports and the Asian demands. Like if the US exports remain strong and Asian demand picks up as expected, rates could see additional support. However, the East will need to resolve its tonnage oversupply before we see any significant recovery there.
Thanks, Akhilesh, for the LPG market update. Let's move on to our last segment. That's the LNG market. Trisha, I would like you to explain us the LNG market for the last week. It seems like the spot rates are still under pressure. So, what's driving this softness?
So the LNG market, it is facing a classic case of oversupply meeting weak demand. Now the spot rates have fallen significantly because there simply aren't enough cargoes to keep the fleet fully utilized. While in the east of Suez, rates are particularly low due to the surplus of tonnage. Now, meanwhile, in the Atlantic, rates have stabilized somewhat thanks to the steady discussions for December and January charters.
Alright, so how is the long term LNG market shaping up?
Now, see, that's where we are seeing some activity, right? New build contracts for deliveries in 2026 and beyond are being finalized, and it is reflecting the growing importance of LNG in the global energy mix. But, however, in the short term market, the market is unlikely to see a major turnaround without a surge in seasonal demand.
Thanks, Trisha, for that update. This brings us to the end of this episode. I would like to thank Sandesh, Akhilesh, and Trisha for the insights today. It's clear that the tanker markets are dealing with a mix of challenges and opportunities right now. So, to all our listeners, thank you for tuning in into this week's episode of the Weekly Tanker Market Podcast. Do not forget to share, subscribe, and follow us on social media for the latest updates. Until next time, navigate safely and stay